What's up, investors? The Dutch investor here, and today I'm bringing you another part of understanding the business, and this time we're going to talk about DGOC's financial model. I hope that you're able to hear some difference in comparison to my previous videos, because I got a new studio microphone. I'm out 120 bucks, so I hope it's worth it. Oh, sorry, there's something wrong there. So yeah, the financial model. Previously we had talked about targeting low cost, long life, low decline production and the reduced unit operating costs. And as I mentioned then, today we are going to talk about the generate return on equity and safeguarding the balance sheet. What may be interesting about the generating return on equity is the strong free cash flow that they want to generate, as you can see right at the start of this picture. So I want to show you how they are going to do that, or how they should be doing that. So bottom line, that is the free cash flow. How is the free cash flow calculated? You take the operational cash flow and you deduct the capital expenditures from that, which is basically capital costs. But you might want to know how you calculate the operational cash flow, and that is basically starting with the net income, also known as earnings income, and then doing some cash corrections, so what actually went out and in as cash. And well, you probably know how to calculate the net income, that is the gross profit minus all other expenses. And to calculate gross profit, you basically just take the revenue and you take the cost of revenue off that. So that's basically it. And what needs to happen for the free cash flow to grow? That's what we want to know. So it can grow in many ways, but one way would be to reduce capital expenditures, or you can increase your operational cash flow. And maybe a bit obvious, but you can also increase your net income. And you want to reduce your expenses if you want to increase your net income, or you can reduce just the cost of revenue, but above all you want to be increasing your revenue. So we're going to check if everything is basically happening as we want to. So we're going to check if it's either growing or actually decreasing. So let's have a look. So here you have a sheet where you can see several items, but I'm going to focus on two things. The total revenue. Here you can see that in 1 year they have increased it by 87%, which is a very big increase. If we are going to look at how they safeguard the balance sheet in a bit, you will notice that they won't be able to always grow like this, but a 15 to 20% growth rate should be actually sustainable. So that is something that we're going to look at later with the outlook. And something else is the total cash costs. Here you can see that they reduced it by 10% in 1 year, and that is the cash costs. So that's basically cost of revenue plus all the other costly expenses, basically, if you just remember the previous sheet that I showed you. So then we are going to look at how these costs are built. So what exactly is that cash costs made out of? And here you see the first one is the general and administrative. So basically the cost for accounting and doing all your finances and stuff like that, and keeping everything in order. Just the finance department, basically. Here you see, like I pointed an arrow at the $1.17, but if you look here, you see that it was $1.34, so they have decreased it by, what is it, about 15%, so that's very good. And if you look at the second one, which I would like to go to as well, is the third one, is the gathering and transportation, third party. And this is something that I mentioned in the business model, that they have to pay fee if they want to use midstream assets, so logistics to get the gas from one place to another. If they do not own it, they have to pay a fee for that. And here you see that in 2018 they paid a fee of about 68 cents. Sorry, that's a bit too reddish. And here in the next year, where the arrow is pointing, you see it's $1.28. So it is almost a double in cost, and that is something they cannot control. So this is why they are trying to obtain these assets, because the moment they own them, they know what maintenance is going to cost, and they basically know what the cost is going to be. So it's more calculated and so on. So it's very beneficial for them to own the midstream assets. And then to the last part is the base LOE, is the base level of effort. So basically the minimum operational cost. I think that's the best way to put it. And there you can see that it went from $4.73 to $3.31. So it's also a very big decrease. So basically you see a $10 decline, a 10% decline, sorry, but the operational decline has been far more, and only the gathering and transportation costs have increased a lot, and that is basically what is ruining the very efficient operational costs. So keep that in mind. So what I also mentioned is that they can reduce capital expenditures, and that would increase their free cash flow as well. So there you can see capital expenditures. They have a sheet for that, so that's very nice. And here you see the recurring capital expenditures. So these are going to come back every year. These are just costs that they have to make. So you can think of maintenance and shutting down wells and so on, and the total comes down to 17 million. So that is what's always going to come back. Not much you can do about that. The moment they are going to grow, this will also increase on a similar level. Keep that in mind. And this is the non-recurring part. And this is 50 million, which is a lot of money, but this money has been spent to reduce their administrative costs. So they want to unify the whole system, and by unifying them, they will reduce costs overall. So that's what they have been doing. But yeah, that's usually costs a one-time expense, and that is basically what you're seeing here. So the capital expenditures have actually increased, but the reason is mostly because of the one-time expense to decrease the general administrative costs. So to go back to this sheet, what has happened, we are going to look to see if they meet our expectations. So the revenue has been increasing, which is good. Cost of revenue has not been decreasing, but it hasn't been increasing either. So it stays on the same level as revenue. So gross profit is still very good. All other expenses have been relatively decreasing. Not as much as you would hope for, but that is going to come with their one-off expense and capital expenditures. So the net income has been increasing a lot, and therefore the operational cash flow has been increasing a lot. And as I mentioned before, capital expenditures actually haven't been decreasing, they actually have been increasing. Bottom line, free cash flow has still been increasing exponentially, but the capital expenditure is something that we want to keep in mind, but we have already dissected it and we know how it's happened, so basically nothing to worry about, in my opinion. On to the balance sheet, safeguarding it. Here you see how they have been hedging. So what they're doing with hedging is that they know how much they're going to produce or how much they expect to produce in a certain year, and what they want to do, they want to hedge their production so they can sell it in the future at a guaranteed price. So here you basically see that sheet, and you see how they have hedged. So in 2020 they have hedged 90% of their production for $2.70. If you look at the current gas price, it's at $1.60. So because they hedge it, they are guaranteed to get that revenue in for their production, and because they have a consistent revenue, they will have a consistent cash flow, and because they have a consistent cash flow, they basically safeguard the balance sheet. You can see a similar level for 2021. 2022 is going to get lower, and 2023 is also lower. They will hedge that in the future to 90%, but that is going to take some time. So we just have to be patient, and the chief financial officer will be constantly hedging until it is reached 90%. Oh, I forgot the arrows. My apologies. So yeah, basically those two are the most important ones. So onto this one. This is how they allocate their free cash flow. So how do they allocate the capital, and is it going back to the stakeholders? And here we can see, yes, it is going back to the stakeholders, also known as the shareholders, and 40% of 40% target of free cash flow is dividends. And here you can see in the bottom that they paid $105 million in cash flow, in dividends from their free cash flow in 2019, and that is about 40% from the total amount of free cash flow that they had in 2019, which is a great number, and it's a very safe payout ratio, which is also something you want to be looking at. So the debt payment is about the same with $100 million as the dividend payments. This is also a way to return value to shareholders because they pay off debt, and because the debt has been decreasing, the value of the company, also known as equity, has been increasing. So this is also basically coming to you as a stakeholder, but you will never experience this on the price of the stock. So keep that in mind. And finally, a share buyback program. If they have extra cash, they will buy back shares. They have been spending $53 million in 2019. I believe they spent about $10 million more in 2020 for share buybacks, and the program is ending in April. And I am hoping, because the prices are still at a very low level, that they're going to initiate another share buyback program, because this is just another way to return value to shareholders, which is what we want to see. So to focus on the debt payments, we want to make sure that the balance sheet is going to be okay. And how do we know that they're not going to increase their debt to a level that is unsustainable? That is very important. So if you look at the top, you will see a picture, and this picture is showing their debt to EBITDA, also known as leverage ratio. So if you have your debt amount and you divide it by your EBITDA, which is your earnings before interest, taxes, depreciation, and amortization. If you want to know what that is, Google it, or let me know in the comments below and I'll make a video about it if you want. And what they do, they have a range in which they want the leverage ratio to be. So they want it between 2 and 2.5. Right now it's at 2.3. By paying off debt, they will lower debt, and if they lower debt, the leverage ratio will also lower. They can also lower the leverage ratio by increasing EBITDA. So it's basically the way it works. So if they have lower debt, they can increase their debt again. By increasing debt, they can acquire more assets. By acquiring more assets, they will increase production, and by increasing production, they will increase their EBITDA, which will also lower the leverage ratio. So this system is a very healthy, solid system, and if they stick to it, it will guarantee a very safe balance sheet. We want the leverage right now to go lower, but if they have an opportunity to acquire something, we would like them to buy it, because if they buy it, EBITDA will increase, the amount of debt that they can pay off will increase, so the debt will decrease, leverage ratio will go down again, they can acquire more, etc., etc., etc. It's a great wheel, and that's that was it. That's basically the financial model of DGOC. Thank you for watching. Stay tuned for the next 3 parts about financial statements, management analysis, and the outlook, thesis, and valuation of the company. Especially the valuation, you're going to be in for a surprise, because what I've said previously was very safe, and in this case I'm going to use the system that they use for safeguarding the balance sheet as a way to measure the future growth, and calculating using that with the calculation is going to create a very unexpected increase in the share price. So stay tuned.